I hope all of you can see the screen in which we have the worldwide, connecting different cities in the world, that says business planning expertise for the upstream oil and gas industry. That's Palantir. That's us. We are a global consultancy and software firm, leading provider of integrated dynamic planning solutions to the energy industry. We have offices in different cities of the world, as you can see here, almost a 24/7 company. Our main clients range from super majors to IOCs and also smaller companies in the globe, different continents in different types of assets, ranging from unconventionals to conventionals, oil sands, integrated economics as LNG valuations. The combination, what makes us, is a combination of software, services, and expertise that combined produce solutions. So you can see that we have two differentiated suites, the AX suite for assets and the corporate suite. Under AX, we find PalantirCASH, Plan and Resource, and under the corporate, the same PalantirCASH and Plan, different version, more horsepower, and financials as well, since at the corporate level, we're more interested to start producing and gathering financials with a focus on reserves as well. Underneath, you're going to find Palantir Data Flow, our planning space. That's a common currency that has proven very valuable for those clients that are utilizing it to standardize data, eliminate noise, follow-ups that take weeks, and reduce that data capturing, standardization, and validation step into a few weeks. And that's the range of savings you can see there, from months to weeks. Our services combine the expertise we as a company gather from all our consultants and developers. We have proven our business consulting acumen, strategic consulting, technical, and also provide training. The solutions, as an example down here, that we can deliver fall under research and economics. If you require a rapid portfolio analysis, we can do that, definitely have done it. Decision risk analysis, risk scheduling, fiscal modeling, and all the other ones you see here. Being one very applicable nowadays as to the latest bid rounds we have seen, and in field development planning that's taking more and more interest. Challenges that some of you have definitely seen in your day-to-day is that it takes time to collect data. It requires also to support it with analysts, specialists. It's difficult to repeat. We have too many systems sometimes. Going back to that common currency, too many currencies, too many data standards. The idea is to focus on the process when probably what we want is really to get the numbers in order to get quickly, to get the insight and make more time, save time, and use it to find more value in our analysis in our own assets and negotiate better and produce better. Decisions made without timely data take us sometimes to maybe a guessing game, more based on sometimes good feeling that industry analysis. Anticipating, shrinking, shortening the cycles allows us to have the data in our hands before making those big decisions. And well, that translates sometimes into mistakes that are capital intensive, and nowadays with the price environments we face, plus some restrictions on budgets, it's more and more important to better understand how to invest every dollar. As an example of what we mean by integrated dynamic planning, we can start with a linear process. Different offices connect in a company with operating assets, business units, elevating the numbers, the inputs, properties. Everybody has its own tools, so we have a different combination of standards, data definitions that create confusion sometimes, and recycling, onerous recycling. It's a linear process, works, but it's onerous. When we think about an integrated dynamic planning, which we have implemented now at some of our clients, we can see common currency all over the place. An asset suite supporting assets with quick solutions, then a more sophisticated with more horsepower solution at the corporation or headquarters, as you can see, regional headquarters, North America, Africa, Asia Pacific, etc. In this example with a headquarter in Europe, in which the planning space, where we combine all data entries in a single repository, and then we keep utilizing the corporate suite to produce some financials and reserves in an integrated manner, iterative manner that works flawlessly, seamlessly, saving significant amount of time that will be used definitely to add more value to the company. So that's in essence what we mean by dynamic planning. After talking about Palantir, who we are, and our main focus, that is integrated dynamic planning, we are now going to continue on that avenue. We're going to talk about integration anyway. In this occasion, the integration of different parts of a business that makes a chain, a value chain. That requires analysis, requires economics to understand the value of the partials or the parts, and also of the integrated company. And this particular example is going to be an LNG workflow. We're going to utilize PalantirCASH as our main tool. As you know, E&P companies that invest in upstream gas projects sometimes find massive reservoirs that can be monetized into LNG volumes sold to different destinations, Asia, Europe, and at that moment they require a different type of analysis, not only an upstream analysis. They need to understand and invest in an LNG plant, trains, even in shipping operations, in order to truly monetize that reservoir by selling LNG at the client destination. Let's say Japan. That's how far probably we have to go if we have a development in Western Africa, Eastern Africa, in Trinidad and Tobago. And we need to understand every step, because every step will have an impact on the previous step and the following step in part. These large volumes and massive capital investment required for financing are going to create an impact on the final cash flows that we need to understand, because ownerships change across the value chain. It's rare to find a single company owning the same working interest in the upstream, in the LNG plant, in every train, even in the shipping operation. Also, there are interactions there that will come back to the upstream to understand for the first time the true value of the upstream. So as you can see, we are starting to talk about several steps in which we need to understand everyone and the connection between them. That's the integrated part of it. Furthermore, we find that for each one of these components, there may be different fiscal regimes, and therefore a fiscal regime and a proper fiscal regime analysis and understanding of the economics, sensitivities, and other is required at each point, at each part, and then as a whole. We need to capture all those fiscal terms, and we need to also produce reports that allow us to understand every part individually in the whole. PalantirCASH has proven to be a solution for this type of integrated workflows. We have more than LNG to discuss, but in this question, that's the example I'm going to follow. And for the LNG workflow, we've been able to calculate key metrics such as break-even liquefaction fee per train, and for the entire plant, break-even shipping fee per route. And if we own a fleet, we can also do that, including the ball of calculation, financing cash flows. Every loan that's given to every part is understood, so it can allow further negotiations with those lenders, understand the government take at each part, at each component, and as a whole in order to negotiate with governments, because sometimes we believe one of the parts look great, but it is the whole really that probably requires a second look in order to understand how to approach a government and negotiate with them, and also invite them to take the similar view. So when you are on a table, everybody is talking about the same view. And this is not new to LNG. There are always complex farm out agreements at some point of the life of large projects. Some partners may want to sell all or part of its positions in a given project, and therefore it's important to understand those agreements beyond carries. The way we Palantir understand an integrated model for LNG is encapsulated in this diagram. We find three main components. That's how we have worked the solution with clients. One component is the upstream, governed by its economics model. The other is the LNG plant that incorporates or includes the facilities, jetties, storage tanks, etc., and the trains, of course. And a third component, which is the shipping economics model, or the shipping operation, the LNG shipping. The rest you can read here, but what matters is that in the upstream, we need to understand what volumes we're going to produce. Our marketing team is going to tell us we have commitments and find a way to meet those commitments. With those volume profiles, production profiles, we can understand how much, what volume will be sent to the LNG plant to be liquefied. Out of the plant, after utilizing fuel, we know how much will be provided to the LNG shipping fleet. Some of that volume will be sold FOB at port, others at destination, and therefore we need to understand how much was used as fuel during shipping, how much was used as fuel during the liquefaction. Furthermore, that LNG plant is going to become, in a tolling fee or in a tolling model, is going to charge a processing fee to the upstream. So that's why the liquefaction fee will go back to the upstream. Even at that moment, we're not ready yet to understand the value of the upstream project, because we need to understand the weighted average FOB price to value the upstream production. In between, we can understand how much every partner is contributing and getting out of every of these components and subcomponents, and also understand the financing options for each one of the components and subcomponents in order to negotiate with lenders. That's a very crucial, important part of this workflow. Something else that's worth mentioning from this diagram is that in the end, we also would like to understand the position for every company, even the government, of all the LNG integrated plant in operation. At the moment, we will need to aggregate cash flows, financing cash flows, government takes to understand the full view of an integrated project like that. So you're already inferring that there are several steps, that it's a certain order we want to follow, that there are iterations, very likely involving manual steps, and that an integrated model encapsulated in a single application will help us solve this. I'm going to now zoom or mention the key points about PalantirCASH in order to understand the value evaluation of this integrated LNG project. We need to also understand a bit about cash. So PalantirCASH is our economics engine. Allows us to not only manage data, but also align different sources, picture, Excel, certain databases, doesn't matter. We're going to gather that information in order to feed fiscal regimes. We have more than 100 in our library, 150 actually, more than 150 EMP contracts there modeled, feeding those fiscal regimes in order to calculate economics, run sensitivities, produce reports that will allow us not only to understand the cash flows, but understand, if necessary, how taxes work, and produce audit reports to make everybody comfortable with how the calculations take place. The example you see there on the right-hand side, it's a very complete report. That's an example of the type of reports that can be generated that will allow us in a quick view, in a single view, understand many KPIs and behaviors of a single project or an aggregated project. The typical workflow in any company would be probably to look at in a full cycle type of project, look at exploration, development scenarios, exploration prospect development scenarios with different applications. It's more linear. What we want to do, or we do in achieving cash, as mentioning, is to include all these scenarios, produce expected values, run sensitivities, incorporate any type of acquisition analysis and produce different answers depending on the scenario and our price assumptions, etc. in a single application. That's how the integration occurs and is no different for the LNG integrated valuation project. For those that know about cash or those that have not, the benefits are tangible. Now, besides of allowing us to gather information and work with it in a single database, we have consistent data. It's very dynamic in terms of the sensitivities we can run, auditable and transparent. Not only the code, which is VBA.NET, but also the reports allows us to really fully understand the project and get the level of comfort, which is very important, trusting software, trusting applications, trusting results in order to fuel a high quality analysis. Where does it fit in our integrated dynamic planning? If you see down here in this lane, the economics lane, that's where PalantirCASH fits in the whole integrated solution. If you wanted to put together and zoom in, what do we mean by that in terms of our applications? This is how. Data flow, common repository of data. Cash takes the validated and standardized data to run economics, clean economics, no need to go back. With our assumptions, sensitivities, etc., economics models, we go there, and then the rest you can follow here and visualize how we can optimize portfolios, provide reports to management, come back, provide inputs to cash to rerun different approaches, even down here to produce different scenarios and validate data validation to feed up again the economics. So the entire integrated dynamic solution is here. Cash is an important component of it. That's where it fits, and that's where we're going to stay today, in this lane. We're not getting out of this lane, and we're going to talk about a solution there. Time to go back to our integrated project, and if you remember, we had a diagram explaining the three components: upstream, the LNG plant or midstream, and the shipping operation, and with certain results fitting one of the components. That is translated into a workflow with certain steps. We need to follow certain order. And now we're getting into how we design integrated projects in cash. We just don't jump, of course, directly into the application. We think about how we're going to first manage it. And for this solution, which is not an out-of-the-box solution, we have found that there are many ways to interpret and model an LNG project, but at least this is the starting point we Palantir offer. We have found that it's important to have a control panel. HDD stands for Hierarchy Data Document. Assume that's an Excel spreadsheet, massive Excel spreadsheet that works as a control panel, in which we can model our financing cash flows, those loans, feed our LNG trains and facilities. As you can see here, we have the financing for the upstream also coming from the control panel. We can get all volumes out of the control panel to feed the upstream, to feed the LNG trains, to understand once we calculate the upstream what production volumes are going to reach the LNG plant and different trains, what outlet volumes will go into the shipping fleet. So in other words, what we want to understand is there is a discussion initially to understand how we want to model an integrated valuation. Then we use cash, which is very flexible and accommodates in different ways to make it happen. And that's what happened here. So no need to really follow thoroughly this slide here. But we're going to get into in a moment into how that happens in cash. Briefly, I would like to talk about how that solution looks in cash then, before we actually see it there. That modeling that starts with a discussion in diagrams translate into a single hierarchy. That's how cash operates. For those that don't know it, a hierarchy would contain, and you can already infer what's going to be there, our upstream fiscal regime and project, LNG trains, facilities, and fiscal regime governing the LNG plant, which is a midstream sort of different type of contract, the shipping project, and model governing the calculations of shipping costs and FOB and DS prices. So no surprise, that's what we find here. plus what we mentioned in our discussion, that control panel. So that's what a hierarchy data document is. It's a control panel. Here it is. The fiscal regime for the upstream is here. The upstream project is down here. Fiscal regime for the midstream for the LNG plant, we can find it here, along with the plant facilities project in the two separate trains. The LNG shipping project is down here with the model that governs the LNG shipping calculations. So what we said in a diagram, holistically, what we decided to do in a diagram to implement a solution has been translated into a cash hierarchy, as you can see here. What are we going to find there in each one of the components? Well, we're going to get into that in a moment. Nevertheless, we can mention that we're going to find financial cash flows in the hierarchy data document. We're going to find production profiles in the upstream. We're going to find for every single train its fee charged by the facilities side of the LNG plant. There are common costs that must be shared between trains. We're going to find a tolling fee that each train is going to charge the upstream. We're going to also see how those LNG trains will produce an output of LNG that goes into the shipping model and operation to understand what volume is shipped to different destinations, which one is sold at port. All right, so with that said, what are we going to see in cash? We're going to talk about an LNG integrated project that includes a full cycle upstream project. It's going to be a dry gas project offshore. We're going to use a generic PSC, sort of a generic PSC, and we're going to have in the partners group a national oil company and international companies. The LNG plant will have two trains, could be more, but for example, I believe that two is good enough. We're going to find LNG facilities, storage tanks, jetties, etc. This is a tolling model. The LNG plant charges the upstream for liquefying the dry gas. What we want in the LNG plant is more a pipeline type of model. We're going to assume that it works like a markup on costs. At least that's the starting point for the analysis, and we're going to see why it's important to bear that in mind. We're going to see the different financing models for training facilities for the LNG plant. The upstream will be financed fully, funded fully by every partner. There is no external finance from banks, for instance, from lenders. Nevertheless, in the LNG plant, we'll see there is a financing. And for the LNG shipping model, we're going to see how, briefly, we can understand single routes, single clients, we need to negotiate with them, combination of routes, different prices, how much boil-off is burned naturally or utilized as fuel, and also whether we want to lease or own the LNG fleet, LNG tanker fleet. The only partners in the shipping operation will be IOCs. Usually, from what we have learned, we don't find NOCs interested in that shipping operation, at least from what we have found. All right, so with that said, I think it's time to move to cash. So I'm going to switch there. For those that haven't seen cash before, quickly, cash works with several hierarchies. We can have many. One example of our standard hierarchy, that comes with our cash licenses, is fully blown worldwide hierarchy that contains regimes. As I mentioned, there are 150 plus from different regions of the world. You can see here that we have a very good variety. How do we move in cash? Well, we just switch hierarchies, and that's what I'm going to do in order to stay here where we want for today. I move to the LNG integrated valuation hierarchy, and I find those three elements we have been discussing so far. The upstream, the LNG plant, and the LNG shipping. This is my control panel, the upstream with the regime, what we saw practically in the screenshot. Yeah, all the elements are here. So we're ready now to walk through, to go through this solution. Let's start with the fiscal regime in the, no, not yet. Let's understand the control panel. Control panel as such is a very important component of the solution. This control panel will gather calculations for understanding the loan for the LNG plant, the first 4 tabs. This is flexible. This is Excel, as you can see. Cash is in Excel adding, so all the flexibility of Excel is incorporated in our solution. We're going to see the tolling fees, understand the LNG volumes, what comes out of the upstream into the LNG plant, out of the LNG plant, the different heating values, because we may find that not necessarily the same heating value applies to all the dry gas extracted. And in the end, we're going to see how the LNG plant interacts, so understand the different pieces between the different pieces in there. Let's start with the LNG facilities loan. This is an example of a loan. Talking about financing, we may find different banks lending money to investors in the oil and gas industry. As a lender, they would like to know credit history, but also which clients are purchasing the LNG, because if these clients have a good credit history, it helps the borrower. Also, we need to understand that this is a different business. This is not the upstream. This is LNG. This is processing. So we want contracts. We want signed contracts, long-term contracts. The other details are that every bank may have a different loan term, different interest rates. That's why in this example, for the facilities in the LNG plant, think about storage tanks, jetties, etc., we have 2 banks, each one lending 30% of the capital required there. We required $4 billion, out of which we are going to ask for 60% in loans via 2 banks. And negotiations landed into these interest rates and those terms. The rest is Excel, but it's pre-done. It's there. It works. In which we are going to understand what's the interest during construction and what's the interest payment once we start producing. We start producing in 2022 in this example. We have 3 years of exploration, 4 of development, and then we start producing. And that's what we see here. This is a way to understand financial calculations. See that we're not talking about small numbers. This is a massive investment. I'm using dummy numbers, rounded numbers, but nevertheless, they're not that far from reality. So for certain facilities, we are already talking about a financing cash flow of $2 million, and that's the financing cash flow. We still have to fund 40% of the rest. Moving to the right, we're going to see the same thing, basically, for train number 1, different approach, because now we may find different partners. Not necessarily the entire LNG plant will have the same partners owning the same shares. Maybe when it's time to negotiate this, some partners may say, you know what, I'm really only interested in a train, and I want a contract there. So not only the partnerships start to matter, or understanding how the partnerships are going to work start to matter a lot when we discuss integrated valuation chains, especially in the LNG, but also how to approach the government if now we have so many, not so many, but different partners looking into an interest in portions of the LNG plant, when probably we have a single contract governing the LNG plant. So that's it. Different terms, different banks. Don't believe that bank number 1 for train 1 is the same bank as for the facilities. May be different. Partners may be different. Also, the terms, the rates, everything varies. Every loan will be scrutinized and should, that's our recommendation, analyze separately. So not to bore you, here we find our financial cash flow for train number 2 and for train number 1, and for train number 2, the same approach. 1 year later, we invest in train number 1 year before than in train number 2, since train number 1 will be online 1 year before train number 2. That's what you see here. How do we capture all these loans? Well, it's just another Excel tab in which we sum all the loans, because in the end, there's a point in which you want to understand how much money we're lending, how much we're paying in interest for the project. I mean, the construction. Moving to the right, understanding our control panel, small numbers that are going to help us as well in terms of different tolling fees, if we want to keep track of them. This is a very important tab, the LNG volumes. This part is key. This is something that we've learned is recommendable as well. Rather than inserting in cash our production, it's better to control it from this control panel, center of operations. Here we insert the production we expect that's going to feed train number 1, that's going to feed train number 2, and then we calculate with an upstream shrinkage what's the volume really entering train number 1, the inlet volumes, as you can see here. I don't know if that's too small for you to see. Let me maybe make it bigger. Same would apply for train number 2. We understand that total throughput, there is an LNG shrinkage. We're moving up in the value chain. We have processed our LNG, but we have consumed fuel, dry gas as fuel. So we have shrinkage. What's truly the LNG out of the LNG plant per train? These are the volumes. If we wanted to know what the average of shrinkage from production to the output of the LNG plant, we can have it here. The important thing is that we now have understanding of what's our LNG production in total and per train. Heating values mentioned a moment ago, but not necessarily every train will process same blend of dry gas. Probably would be very similar, if not the same, but it's a good idea to track it separately and also understand if we need to any weighted averages that may help us in future analysis. The important thing of the last tab, the LNG plant tab, is that in here we're going to understand how the different parts of the LNG plant work. So let's go there. By the way, we're already in cash, we're already working with a cash document. This is a hierarchy data document in cash, in PalantirCASH. That LNG plant, as we mentioned a moment ago, has facilities, train 1 and train 2. That's what it has. So that's what we're going to be looking at. The facilities will process volumes, total volumes. So there is an inlet for all facilities. Here it is. That project, those facilities are worth $4.4 billion, including abandonment capital, and have a yearly OPEX, fixed OPEX. I'm maybe oversimplifying a bit there, but for the analysis today, fixed OPEX of $100 million. So our total costs are $6.9 billion. And we mentioned that this LNG plant will work, for the sake of the starting analysis, as sort of a pipeline type of model in which we are going to add a markup to costs. We can control that from here. For the example right now, we're using a 15%, which is a hefty markup on costs for this type of models. And that's how here simply we can calculate based on assumptions like spreading the depreciation over 5 years and recovering directly those costs through a toll fee that the plant facilities will charge to each train. We come up with those fees, as you can see here. This is Excel so far. How do we allocate that per train? Well, trains start to produce in different years. Remember, we are train number 1 will be online 1 year before train number 2. So that's why train number 1 takes the entire allocated fee per MCF. Here per MBTU, we have differences of units there if we want to track them. After that, it's logical to find if these two trains have similar production, the same production every year coming in, they should take the same share based on production of the plant facilities costs plus markup. And that's what we did here. So far, it's Excel, relatively simple, but organized, so it can help us understand what's happening. Let's stop here for a moment, because now, for the first time, we're ready to calculate economics. Why here? Because if you have realized and remember the diagram, or know enough about are familiar with LNG projects, we need to understand the FOB prices to value, for instance, the upstream. We need to understand the toll fee that the LNG plant is going to charge the upstream. So actually, the upstream is the last calculation we're gonna be making. The first one here is LNG plant facilities. We understand the economics there. We understand how much they want to charge to the trains, so we can have a feeling of what's happening there. Let's do that. We have all our costs. We have our financing. Let's go and see what happens down there. This is the facilities project. How did I get there? I'm going back to my hierarchy. The only thing I did was to open that project by double-clicking in this project, LNG plant facilities. I'm just working with this, so we have everything here faster. We move from left to right, for those that are not familiar with cash, in which we're going to find inlet volumes. These inlet volumes come from the HDD. As you can see here, there is a link to the HDD. We already saw where. Remember where? LNG volumes, inlet volumes. That's where they come. So we have all those volumes into our facilities. That aggregation, along with the same link that comes from the control panel, all this gray, dark, not darker, like put it, yeah, more silver, at least in my screen, I see them as silver fields versus gray fields. The silver fields are linked to the HDD, the control panel. That's how I know. That's where we get all the BTU content. And moving to the right, I also find the tolling fee the facilities are going to charge in order to produce that 15% markup on cost. So these numbers should match, obviously, because they're linked to our integrated project, should match those values, and we find them here. 1014, 380, 1014, 380. That's where they are. So everything interconnects. Let's keep going. We said we needed to invest $4 billion. Here they are. With abandonment 10% roughly of 400 millions. Our operating costs, 100 millions per month. Here they are. We could also think about linking them to the control panel. For now, I just kept them separated as a copy and paste so we know what's happening. But this could be linked directly as well from there. So we control everything, actually everything, almost everything from our control panel. If we had any G&A or bonuses, in this case, we don't. Any carries, we don't. And this is something that is probably new to this type of analysis, the financing cash flows. We want them here. We don't want to think that we may want to take a look to cash flows, including the financing impact later. It's important to see them now. Here they are, and they're connected to the HDD. We already saw where those tabs are in our control panel. Now, how did I generate these calculations? Calculating this project, those are not cash. What we're doing is taking all these inputs that came from the HDD, those that came directly from the project, and we send them to be processed in the fiscal regime. Now we have results. As you can see, our costs, 6.9 billion. This is the toll fee charged to the 2 trains times the inlet volume to the LNG plant that produces these cash flows in this fiscal regime for the LNG plant, which is very simple. Here I'm assuming it's revenues minus costs, and we pay taxes. That's it, which produces these results, before tax cash flows of $1 billion, nearly 600 million of income taxes. Our loan financing is heavy, as we can see here. It's a $2 billion financing net cash flow after receiving our draw and paying interests, as we can see here, and our after-tax cash flow is negative 1.5 billion. I don't like that. I think that probably that model of 15% markup on costs looks great, ignoring the financing cash flow. But if we have to, because we have to finance this project, there's not enough capital. Plus, the partners interested in LNG facilities are not necessarily oil and gas companies. They have different type of cash flows and balance sheets sometimes. So no, there's something there that doesn't work. So we already flagged something in our initial pass and starting point, and that's why this type of integrated valuation chains, including financing, for instance, are a starting point. They need to be discussed. They need to be understood. Here, we're understanding that that markup, initial markup proposal 15% look great. It's not that great if we include financing. So let's take note of that. Let's continue, because in the end we want to have our first pass. The gross pass is for the plant. The net pass is for the partners. So I'm going to zoom in into the partners. Which partners do we have? In the LNG plant, we have IOCs. For partners, we are, in this analysis, the company with the splits. As simple as that. So our 35% of those cash flows will be reflected in the net tab. Here it is. So this is how much we are losing, $500 million. All right. Let's continue. So that was the LNG plant facilities. Now, let's go back to our control panel. All right. I know the economics there. I already took note of what I needed to. Let's move on. On to train 1. Train 1 is receiving a toll fee from the plant. We have it here. And we already know it's going to be linked into train number 1. Train number 1, similarly, will have its own costs. Here they are. $2 billion plus capital abandonment. This OPEX includes the toll fee from the LNG plant. So we need to calculate the LNG train in order to produce those numbers. With a markup of 15% on costs, total costs, we know now how much train number 1 is going to charge the upstream. Here we have. So let's do that. We're understanding our step number 2 in the LNG plant. I open our train number 1 project. You know from where. We go into the application, double click on this project. Here it is. We have production going into this train. We know it comes from the IGD, with shrinkage coming from there, heat content, and a price. This price is the fee the LNG plant is going to charge. In order to calculate that one, remember that we needed to capture the costs that come from the plant facilities. 989.5. Just a quick check. Oops, sorry. Here it is, 99. I'm rounding here to 2 digits. So everything is interconnected, easy to follow. If you need to explain them, you come back to the control panel. Some of these steps can be further automated, but as I mentioned, I'm doing this so we manually understand what's happening for to follow every number and fully understand what's happening for further negotiating with governments and banks. All right, so we get the number. We got into the financing tab. Yes, we are financing this train. When we go and calculate our cash flows with a different type of partnership now, we may find probably the same partners, and I'm moving here into our cash flows, the same type of partners. Quickly, let's check that. But with different positions. We had 25% in the facilities, and we have 40% in this train. This train itself, including financing, is not breaking even. It's a $500 million loss, and our share of that, 40%, should be a couple, exactly, 200,000. Sorry, 200 million. So we're taking note of this one as well. There's something there in that model that doesn't work. And not to repeat the same step for train number 2, I'm just going to show you that's exactly what we did. Train number 2 has capital investment, has OPEX. That includes the fee, the toll fee that the LNG plant is charging to it, so there's one. With that, we have OPEX. With OPEX and CAPEX in the markup, we can understand the fee that train number 2 will charge to the upstream. So we do all that. We understand how much is gonna be, and we have economics for train number 2. Train number 2, different split of partnerships. Every partner takes, train number 2, yeah, every partner takes a 25%. When we calculate those economics, we get a gross pass, including financing, again a loss, and our position, still a loss. But there's something there that definitely doesn't work for any part of the LNG plant. That 15% markup on cost is not working for any of the components. But there is something there, and definitely that's not going to be liked by the lenders. Obviously, they want to see positive cash flows, positive NPVs to start with. So we get to do something about this, renegotiate probably with the government. Now we understood this important piece of the LNG plant, and it's moment to probably think about what to do. When we are in that type of situations, what we want to do, for instance, is to better understand our fiscal regimes. I'm opening the fiscal regime that governs the LNG plant just to understand the basic terms. I'm assuming we all know them because obviously we already discussed this integrated valuation chain. Nevertheless, let's see where, more importantly, where we can find room for improvement. This is a model, this is the contract. Let's pretend we already know this, that takes revenues minus costs and pays corporate tax. So there's not much room in a model like that to play with, but probably in the corporate tax rate. So let's see how it is set up. The corporate tax rate, according to the contract, it's of 30% on taxable income. Maybe we can try to negotiate a different tax rate for this contract only. But tax rates, corporate tax rates, are sometimes difficult to negotiate. They tend to be outside the jurisdiction of any Minister of Energy. Nevertheless, probably a tax holiday, it's something we want to negotiate further and have during the initial, I don't know, 5 years, 4 years, 3, a tax holiday. So we don't pay taxes or pay a smaller rate, and that allows us to offset the loss that we see. Another easy one is to keep increasing the markup. So we're not trying to solve the problem here, but what I'm bringing here is analyzing the plant, every of its components, the partnerships, and the financing cash flows that depend on the partnerships, depend on the clients, depend on the terms and the volumes. We see that cash flows are different, even for train number 1 and 2 having the same costs, same volumes in and out are different, the cash flows, because the facilities, the LNG facilities plant is charging slightly different fees or transferring costs slightly differently to train 1 than to train 2. So it's insight what we're bringing here, not establishing this analysis as the solution. No, it's the insight this workflow and integrated evaluation brings and recommendations for what we have learned. All right, so that's something that can be done. Let's park that for the moment because we need to complete the analysis of the entire value chain and see where else we need to renegotiate or rethink what we have for now negotiated. All right, so I already saw the regime. Quick comment on those that haven't seen cash before. This is a fiscal regime. Every box is made of VBA.NET code, so it's limited to that particular operation, calculating revenues, calculating operating costs, depreciation settings, so on and so forth, cash flows. So it follows that order, breaks it into different parts. It's easier to follow, monitor, modify, etc. So the advantages are there, and it's open code. If you want to see it, it's open. It's not a black box. It's definitely open. It's very helpful if at some point you want to see it. Contract terms, we already saw what they are useful for. How do we set up? Now, if we had a withholding tax, which we have, probably that's something else we can negotiate. If we want to take profits, expatriate profits, well, maybe that's another point. But again, maybe it's more difficult negotiating that type of deals, type of items, I'm sorry, with a Ministry of Energy. All right, let's continue with the analysis. Next step, we're moving on to finalizing the impact of the LNG plant. The LNG plant altogether, in the end, that's what's going to happen. Altogether is going to change the upstream a toll fee through to trains. We see here how train number 1 produces a toll fee. Train number two as well. But in the end, that's sort of a weighted average. So the calculations here to the right are Excel based. You can infer, guess them. The point is, this is the toll fee we're going to charge the upstream. So now we have that part. The LNG is going to charge this toll fee. That's how contracts are set up, at least for the initial pass, for the initial discussions. With this value, we can now understand that part of the OPEX of the upstream. All right, so now we know that. Now we know why we wanted to track the LNG plant over here to understand the different components and where things land. Okay, so moving on. I'm going to then quickly show you the shipping operation. The shipping operation works pretty quickly. We have different routes. We can go to different regions of the world, sell different volumes into destination or FOB, and with those calculations, we're going to land into volumes per route, per client, in other words, per train. So now we understand how volumes are split into selling to different clients, which impacts the financing, and running this model in order to save the sake of time and allow questions, we get these values. Shipping costs, FOB prices, based on a very detailed set of inputs in which we track costs, boil-off prices, inputs for the train inlets, what's going to be shipped to where, how much is paid to the Suez Canal if we use it, how much is paid to the LNG tanker owner if we decide to lease them, and so on. The shipping economics, it's a complex model, but it's going to produce in the end those numbers we want to see. Now those fees we want to see, and here we are going to understand the loan as well, similar model with one main goal. What is that weighted average DS price? And therefore, if we subtract the average shipping cost, FOB price. That FOB price we want to incorporate into our upstream. With that, we have all the pieces required in the upstream now. because we have the toll fee from the LNG plant altogether, weighted average, not per train, but weighted average. Our costs here coming from the shipping operation, prices, I'm sorry, and we open our upstream project. There, we're going to see that the upstream project follows the same. Has production feeding the different trains, has shrinkage there, incorporates that price for the initial pass coming from shipping operation, understanding in the end all costs up to the point of sale, which is pretty important. Capital, there's capital, development and abandonment for all these wells, all the well drilling facilities. This is an offshore project. There is a pipeline subsea, op costs for operating, op costs coming from the toll fee plant, and the rest, if there is a carry, yes, we're carrying the national company in this case, in the upstream, so we model the carry in order to produce, there's no financing as we said, produce cash flows. I'll just for the sake of time run that, and these are the cash flows for the upstream. Pretty good cash flows. So the upstream seems to be working, but not the LNG plant. That's where we need. Another point is that we can also use result sets in order to see results, aggregated results. That's the last part of the workflow. I want to see my position as a company everywhere. So I'm going to run a project here to understand those. We have some LNG reports that we can definitely utilize, run them for us, the company. Okay, so while those reports are generated, I just want to go back to what we discussed, contracts, a diagram, a plan for implementing this in cash. We implemented it, used the respective fiscal regimes in different parts of the world. Our inputs from the experts were put in this HDD, in this control panel document in which we can track everything, feed our trains, our plant, understand the economics by taking the markup, understanding the financing cash flows, and looking into the separate cash flows to understand whether we need to negotiate in the upstream or need to negotiate in the shipping cost with the owner of the LNG plant, LNG tankers. And now let's take a look to the aggregated cash flows, because that's in the end also what we want to communicate to management. And here they are. This is a gross cash flow for the integrated plant. As we can see here, we have different. Just give me a second. Okay, I have something annoying me here that's not allowing me to show you. Yeah, finally, sorry. Yeah, this report. In this report, we can see a whole pass, for instance, of the cash flows for the government, for different positions, the midstream, bonuses and fees, upstream and midstream bonuses and fees, and that's the aggregation I was talking about. We want to track some elements separate than others, because when we aggregate, we want to differentiate them for auditing purposes, for aggregation of cash flows. And finally, the other, no, I believe I show you all the reports, because we're running short of time, and that's what I wanted to show you in terms of aggregated cash flows and reports. That would conclude our analysis today of the LNG plant. It's integrated workflow, requires steps planning. The advantages, we do this in a single hierarchy where we control almost everything from a control panel with tabs in Excel, which we build. We can explain, we can track. Then we run the economics, understanding the parts, understanding the order. Yes, it's an iteration and requires some manual steps. There's a level of automation, additional level that could be achieved. I decided not to take it and show you certain manual steps. But yes, still some amount of steps are required in order to understand every piece, get the insights, and get ready for further negotiations and split this into all the different parts.
Okay, great. Thank you.
Yes, sure.
So if anybody does have any questions that come up, please feel free to email us at marketing@PalantirSolutions.com. I'd like to thank everybody for joining us today, and thank you, Alejandro, for your presentation. Next week, we do have another webinar, July 23rd, same time, 9 a.m. Mountain Standard Time, and it will be on understanding optionality in field development plan evaluation with Palantir Resource. We will be sending out a mail out as well. You can sign up online at www.palantirsolutions.com. So thanks again, Alejandro, and everybody